Hi, everyone. I'm Ivan Buki, and welcome back to Wall Street Silver. Our guest today is a very special guest. First time on the show, Mr. Joe Brown from Heresy Financial. Joe, it's great to see you.
Yeah, I'm excited to be here. Thanks for having me.
Yeah, it's an absolute pleasure.
Joe, we wanted to have you on. You're new to our audience, but you've been doing. You're a YouTuber. You have a very successful channel called Heresy Financial, 131,000 subscribers, and you've been doing this what about 2 years now, Joe?
Yeah, just about 2 years. The channel started a little bit before that, but yeah, just about 2 years. I've been really focusing on spitting out videos.
Well, what you just recently, let me find it here. You had a great video on silver, which is one of the reasons I wanted to get you on our channel. How far was it? About 2 weeks ago? Here it
Yeah,
is. The silver squeeze is working. Silver squeeze is working. Banks are stuck short. And I'll put the link to this one in the description. But January 7th is when you uploaded it. 107,000 views. So I'd recommend everyone go check out Joe's channel. That's sort of what we wanted to talk to you about. You've developed a expertise on financial issues and somewhat in precious metals also. And your channel's what I would call an explainer channel, right? You see a problem that you want to understand, and then you go figure it out, and then you talk about it, right?
yeah, 100%. And it kind of all started in September of 2019 when the repo market blew up, and there were a lot of underlying issues in the financial system. And then that kind of sparked things that started, QE infinity or not QE. And then, a couple of months later, there was an excuse to print, a couple $1 trillion and the bailout of the entire economy. And so, yeah, looking at these complex issues that are kind of at the foundation or underneath the foundation of the financial system, and trying to figure out what's going on in kind of a way that anybody can understand. So that's what I like to focus on.
Yeah, that's why I watch your channel. I know Economic Ninja, he's also a huge fan of yours. I know a lot of people on our channel subscribe to his channel. So everyone, go find Joe's channel, Heresy Financial, and definitely subscribe. He does some
Thank
great
you.
videos that explain things. Ivan, what's your
Thank you.
first question?
Joe, the Fed is out of control as always. Have they boxed themselves in a corner regarding raising interest rates?
Yeah, so this is it's one of those things that the example I'd like to use is the story that they did the movie on James Franco, 127 Hours, when he fell down and got his arm stuck in between the cliff wall and the rock, and he had to make a choice whether he was going to take the less painful option, which would be to just sit there and die, or he had to take the painful option. He cut his own arm off, and that allowed him, even though that was more painful and hard to do, then he was able to escape and ultimately survive. And spoiler alert for anybody who hasn't seen the movie yet. But that's exactly the situation that I say is that the Federal Reserve is in right now, because for 20 years minimum, they've been making a lot of dumb decisions that are taking the less painful route short term, and that plants the seeds for greater crisis down the road that they then have to increase the amount of intervention. And they've gotten to a point where they're in between a rock and a hard place, really, where you're having to choose between hyperinflation on one side. You're on a tightrope. There's hyperinflation on one side and a deflationary death spiral on the other side. And so that's the rock and the hard place that they're between right now, because if they don't do anything, prices start accelerating, people start dumping the currency. And if they do start to tighten, which they've indicated they're planning on doing, then you have insolvency crop up, because you've sowed the seeds for so much rot in the system that as soon as you start to shut the money printer off, as soon as you start to pull back on that easy money, that flow of easy credit, you establish a giant air gap underneath the financial system that it eventually falls in on itself. And so they are in between a rock and a hard place right now. The question is, how far will they be able to taper and tighten and raise rates before things start to collapse?
Well, that's the big question. They're talking a tough game right now. They're talking about raising interest rates, and everyone just seems to naturally assume that's going to result in everything falling apart, and then the Fed rushes back in. So the big question mark is, how far down this path they're going to get before they have to turn around and come right back with the easy money. I mean, do you have any thoughts on that at this point, or any predictions? And don't worry if you're wrong. I tell all our guests
Right.
we'll delete the video.
Perfect. No, yeah. So it's I think that the problem will come out of Europe. There are a lot of issues, especially with the globally systemically important banks. They're the GSIBs. There are even greater issues with the banks that are not classified as GSIBs there. And I think the issue will come out of Europe with their highly leveraged balance sheets. This rising interest rate environment with the dollar going up, and you're starting to see tension in the financial system, and something's going to snap. It's some emerging market. Somebody's going to be insolvent that was unexpected, and that's going to bleed over into the balance sheets of one of these highly levered banks, and they're not going to be able to support it. And with a lot of these banks, some of these GSIBs, a 2 or 3 or a 4% loss on their balance sheet wipes out their market cap. They are so highly leveraged that a 2 or 3% loss in assets from their balance sheet is bigger than their entire market cap. So something like that happening will bleed over. That's a domino starting to knock over the financial system, that central banks will have no choice but to enter into more easy money, more stimulus, more bailout. They can never complete the taper or the tightening here.
Well, that's the key thing. Deutsche Bank is considered really sort of the sick man of Europe, the biggest bank in Germany. They're leveraged to the hilt with all this toxic derivatives that people like Warren Buffett call the nuclear weapon in the financial system, or whatever I forget the phrase he used. But you see that happening. It's not just the interest rates going, it's not just the loans, it's the derivatives that are going to blow these. Someone's on the other side, someone's a counterparty on the other side of all these trades. And that was the key issue during Lehman Brothers, right? Counterparty risk. Banks no longer trust each other at some point. And then who has to bail it all out? Yeah, the central banks.
Yeah, well, I talk about the hedge fund long-term capital management a lot, because these were the smartest guys in the world, Nobel Prize winners, the creators of the options Black-Scholes pricing model, and they established this hedge fund engaged in relative value trades where you had two positions that were offsetting, you're long one, short the other, and by all of the models, they were not supposed to be able to continue to move away from each other. Once they were priced a little bit further apart, you enter into the trade, and all the models said it would have to move back together at some point, and you get your arbitrage there. And something happened that was not expected, and they started to move apart to the extent that they couldn't handle it, started to close out, and they almost took out the financial system. And the banks today are engaged in the exact same type of trades. They're engaged in trades that are supposedly offsetting, that their broken models say they can't move against them past a certain amount. But guess what? When unexpected things happen, the models that only predict what can be expected don't predict those things from happening, and things start to break. And same thing happened in 2019. When the repo market blew up. Again, same type of issue going on, where unexpected moves start to break the markets, and central banks then have to intervene.
So that sort of plays into the video you recently did on silver. Bank of America might be in this sort of same situation with a massive short position in silver. Can you give us the gist of the argument that you were making in your video? Or just give us the Cliff Notes version of your video here.
Yeah, well, 100%. So in the recent reports over the last year or two, there's a certain amount of opacity in the markets, in the precious metals markets. So take all of this with a grain of salt, because we don't know for sure exactly what these trades are composed of. But there was a massive last year. There was a massive jump in silver in the vaults that seemingly came out of nowhere. And it turned out later on that it looked like that was a big short from Bank of America, that they had borrowed silver and sold it. And then silver subsequently went up. If you look at the timing of this, silver was probably around $18, $19. I see you've got the article. This is all from Ted Butler. So the numbers, are probably, his numbers are probably the most extreme estimates of what's going on. But essentially, after that short happened, the price of silver went up. And so they started losing money, because if you borrow something and then sell it for dollars, and then that thing starts to go up in dollar prices, suddenly you're losing because you have to spend a greater amount of dollars to get that thing back, to give it back when you close that position out. So it looks like they doubled down on their position right around $26 per ounce, and which would put their break even somewhere around $23. So right now they're probably at a slight losing position, depending on how big these shorts actually are and depending on what they have offsetting it. But ultimately, we know that in the system, regardless of the numbers, there are a lot of paper shorts. There's a lot of unallocated ownership of silver. And that's a good position for anybody with a long-term time horizon who wants to own it.
Joe, when do you think we will see the Fed start to do rate hikes? Do you think March?
I think so. So everything that we've heard come out of their mouth, they've stuck to so far. A lot of people say, hey, the taper's not real, but all you have to do is look at their balance sheet, add it up, and we can see they're purchasing less now than they were before. For about 15 months, they were purchasing about $115 to $120 billion a month. For November and December together, they purchased about $100 billion a month. And everything they've said since then is that they're going to accelerate that so that they're not purchasing anything on net by the end of March. And then they'll start raising interest rates. And some Fed officials are now actually saying, as they start to raise interest rates in March, they will also start to sell assets off their balance sheet, or at least let their balance sheet run off when the debt matures. So everything coming out, at least verbally, is taper faster, tighten faster, raise rates faster. So barring any extreme economic failure, financial institution insolvent overnight, the stock market starting to drop 20%, hitting circuit breakers. If something like that doesn't happen, they will continue on this path because they see the dangers of the inflation on the other side. So they're trying to get as close to that deflationary policy as possible without actually triggering the crashes. And I think they'll continue until the crash does start to appear.
Yeah, that's the big question. Where is the pain point? Is that a 20% market decline going to be the pain point? Is it Nancy Pelosi giving Jerome Powell a call and saying, "Hey, my husband's stock portfolio, his options trades on Tesla or underwater. You need to turn on the juice again." I mean, or is it, or do we need a real failure in a major bank or hedge fund to happen before? It's like we're in a game of chicken right now. Between the Fed and the market, and as to who blinks first.
Yeah, we have, it's kind of ironic right now because we have this, there's kind of a buffer in the system because of the political gridlock on spending right now. And so if, they recently got past the debt ceiling issue, my expectation was that once that was done, they were going to be able to start spending a lot, borrowing a lot, which that's new debt hitting the market. And we know the supply and demand equilibrium, if new debt hits the market, all else being equal, that will drive the prices down because supply is higher, which is going to drive interest rates higher. And so that's what I was expecting to happen. But there's been this political gridlock that has prevented a lot of the new spending packages, a lot of the new borrowing. So that's kept a lid on interest rates, and interest rates have been moving up, right? But they had been moving up a lot more if we would have seen $1 trillion, $2 trillion, $3 trillion more debt issued from the government. So there's been this leeway to the Federal Reserve where they have been able to do this without having to worry about rates spiking too quickly and breaking the markets. Because if rates start to really take off here, and I know they've been accelerating recently, but if they start to, if they go 2%, we're looking at the 10-year right now, if they hit 2.2, 2.5, getting closer to 3% really quickly, that could start to break things fast. And so they've had this leeway to be able to stop buying government debt because there hasn't been that much government debt hitting the market, and so they've had a cushion there.
Well, something, so many people have no comprehension these days of what normal interest rates look like. You take the 10. See, look, we've been below, let's call it 4% for almost a generation. The great financial crisis, was 2008 to 2011. Here's 4% right here, where I'm at right here. Normal interest rates before that, go back in time, 7%, 8%. And this was during a healthy economy during the 90s, 7%.
Yeah.
Could you imagine the 10-year bond being normalized from 1.8% back to, let's just call it between 6 and 8. I mean,
Right.
what would mortgage rates be if the 10-year bond, like everything's keyed off of the 10-year bond? Could you imagine mortgage rates being 6 or 7% again? What that would do to
Right.
the housing market?
Oh, it would absolutely crush it.
Joe, Japan came out and they said they aren't raising interest rates. Why do you think they have a little bit more wiggle room for easy monetary policy?
Yeah, this is where it really gets into the culture of things. So if you plot what has gone on in Japan over the last couple of decades, a lot of people compare us and say, "Hey, we've got a lot of room with our debt to GDP, with our balance sheet size, balance sheet expansion, the rate at which the central bank can print." Because worst case scenario, we just end up like Japan, and we're not even there yet. The problem is culture plays such a big part in this, and monetary policy ultimately backs up fiscal policy. And so there are differences. You can't just look at one piece of the puzzle and not the rest. So what the best way to break this down, this is from Lynn Alden. She talks about the difference between base money and broad money. And I like to say that's basically banks' money versus people's money. And so the financial crisis is a good example. People thought there'd be a lot of inflation after that, but the only thing that happened was they replaced bank money. Banks had this much money. It was full of mortgage-backed securities. Then they realized, oh, we only have this much money. So the Federal Reserve just refilled their coffers. They said, give us all the mortgage-backed securities and we'll refill your coffers. So they replaced bank money. That's not money that gets out into people's hands, at least immediately. And so that's not money in circulation. That's not the broad money supply. So there wasn't a lot of inflation as a result of that compared to the amount of money that was printed there. That was bank reserves. That was base money. Broad money is what causes the inflation. And so when you take a look at what Japan has done over the last couple of decades, they've been trying to increase the broad money supply, the central bank has, but they haven't been successful at it because it's just been increasing the base money supply. When you track broad money, both the euro and the dollar have had far greater levels of broad monetary expansion than Japan has. Their broad money in Japan has not expanded. It's been, a couple of percent lower for decades. And one of the reasons for that is because both individuals and corporations have been deleveraging and increasing their savings in Japan for decades. As the money has been printed, they've been getting rid of debt, then they've been saving. And when you contrast that with what happens, especially in the States, you hand out, $1,000, $2,000 checks to everybody, and about 90% of it went to buying clothes, which is the definition of a consumable good, something that doesn't last. It's not an asset. It's not something that won't have to be replaced or that cash flows or anything like that. You're not saving, you're not deleveraging. We look at the total non-financial corporate debt in America. It's at an all-time high. There was no deleveraging that took place as a result of the last crisis here. And so that's the main difference is, here, recently, as the money has been printed, it's gone out into the broad money supply, which causes inflation. Over there, it's been deleveraging. It's been paying off debt. It's been going into savings. There has been no inflation as a result of that. And so the central bank has some more wiggle room and they're saying, no, we're not raising rates. We're not backing off this easy money policy. We're not taking our foot off the gas pedal here. We're going to stick on it until, things, go the way the central bank wants. And so that's the main difference in why they've seen different results than we've seen in the West.
Well, also Japan has a huge trade surplus. Whereas we have twin deficits, right? We have the budget deficit and we have huge trade deficits with the world. Whereas Japan, while they do have budget deficits, they have massive trade surpluses. So it's like they don't have the same weaknesses that we have in our currency and in our system. I mean, we all have our warts. No system seems to be totally healthy, and I think Japan would be the first to admit that they're not totally healthy. They got demographic problems also. But the trade surplus does give them a huge cushion, I think, for what you were just talking about.
Huge cushion. And with that, they've been able to build up a massive positive net international investment position. So they own a lot more foreign assets than foreigners own of their domestic assets. Whereas again, the States is in the exact opposite position. We've got one of the worst negative net international investment positions in the entire world. We own far fewer foreign assets than foreigners own of domestic assets here.
Joe, what kind of silver are you stacking? You stacking coins, bars?
Yeah, both. So my favorite way to do it, I use a service that you store it in an allocated, segregated account, and then you just add to it, regularly. And then once that stack gets too big, then I request physical delivery, because the premiums, if you're buying a coin at a time or a small bar at a time, you're paying a lot for that silver. And so it's cheaper to get it in storage. And then once your stack gets so big that you're like, you know what, I don't trust this anymore, I don't want it in storage just in case something happens, request physical delivery, and you only have to pay that premium once, for a large delivery there.
Hey Joe, what's that coffee mug you got there on your table? You want to hold that up for the camera?
Same, and the Fed.
And the Fed,
Yep.
yeah, it matches my hat. Cool.
Yep, I love it.
Cool. I love it. Hey, Joe, it's been great having you on. Once again, everyone, go watch Joe's video on silver that I'm going to link here in our description. And we're definitely going to have Joe back on in the next month or two, maybe every 2 months, just to get your take on the market this year. We appreciate you coming on and sharing your knowledge with our audience. We really do.
Well, thank you so much for having me. It was a good time.